plant, or POX plant. And for those who aren't into gold, you probably should know that the POX plant allows us to process refractory ore, which is a type of gold ore that's harder to process. It requires an extra step compared to non-refractory ore. And you hear me talk quite a bit about refractory and non-refractory ore as we go along. It's one of only two POX plants in Russia and one of less than 20 in the world. Our gold production this year, we have a forecast of 430 to 470,000 ounces. We are a premium London listed company. We have no controlling shareholder, but we do have one large shareholder, UGC, which has about 29%. Next largest would be Prosperity Capital, which has about 10%. I saw Nikolai Sosnovsky is supposed to be on the call today. Hi, Nikolai. And we are dual listed. We have a listing in Moscow as well. In January of this year, well, let's put it this way. In December of last year, Denis Alexandrov was appointed Chief Executive Officer of the company. That was after some changes in the board of directors last year and some people who departed. Denis is well known to the market because he did a great turnaround story at Highland Gold Mining, where he and I used to work together. And in fact, in January of this year, about 8 of us, former Highland Gold executives, followed him over to Petropavlovsk. And when we joined, we initiated a top-down review of the business and came up with 4 areas where we think we need to focus our work in the coming years. That is to increase gold production from owned sources. Right now, in our POX plant, we process, well, up until now, only about 50–60% of the feedstock for our POX plant was coming from our own mines. We were buying third-party concentrate from the market to top it up. So we need to increase our own refractory ore processing so that we can feed the POX with our own feedstock. And that means also including accelerating the development opportunities for our existing assets. We need to cut costs, focus on operational efficiency. We saw quite a bit of fat, and we've done some work to cut that, and we think there's a lot more to do. And also institute up-to-date systems and controls so that we can control costs better and have a more efficient company. Manage the balance sheet. I think Danila will talk some more about that later, so I won't get too much into that. And improve our corporate governance and oversight. Right now, we have a good board, 5 members, 4 of whom are independent, but we need to expand that board. We also needed to work on our transparency going downward from the board, just the kind of reporting lines, how the company was structured and how the management was structured. And we've already done a lot of work on that. And then improve budgeting and guidance so that the company does a better job of providing guidance to the market. So we hope that all of these efforts will consolidate shareholders around our future goals, and we plan to present a new corporate strategy within the next few weeks. We're going to have a capital markets day and talk about what we see this new management team sees as the opportunities for the company going forward. And one important point of that will be to discuss a dividend policy, because the company's never had a dividend policy and it hasn't paid dividends in nearly a decade. So we think that's something that the market wants to hear from us, and it's something we plan to address. As I mentioned before, when I talked about refractory and non-refractory ore, our POX hub is great because that allows us to unlock the value of our refractory ore resources. And as you can see from this chart here, the yellow is non-refractory ore and the gray is refractory ore. So about 70%, 67% to be exact, of our resources in the ground are refractory ore. So, and we're seeing, Malamir is basically almost totally onto refractory ore now. Pioneer is making the transition right now. And we see Albin as our next potential source of refractory ore. When we came in, what we inherited, this new management team, what we inherited was a trend where production was dropping, basically since the middle of 2019. And the reason for that is our non-refractory ore, the easier to process stuff, is depleting. And we had not kept up with building more capacity to process our refractory ore. And I'm talking about the first stage of processing, which is flotation, where you kind of float the non-refractory ore up to the top and make a concentrate, which we then send to the POX plant. So as you can see here, because of that lack of flotation capacity, we've been watching our production decline over the past few quarters. And there's other issues as well. For example, Albin, our third mine, depleted its main source of ore and now is mining the Elginskaya deposit, which is a satellite deposit, which has much harder ore and much more difficult ore to process. So that's also a reason for some of the dip, but a large portion of it's just the fact that we didn't have, we had to transition from non-refractory to refractory ore, but we didn't have that flotation capacity. On May 31st, we commissioned the Pioneer flotation plant, which is our second one. And as you can see in the second half of this year, actually already starting in Q2, our production is starting to rise again. And that's because we have that flotation capacity in place now, and we can process that refractory ore and send it to our own POX. Talking about the POX, here you can see over the past few years, well, let's say the past few quarters, I should say, the POX has been operating at 50 to 60% capacity, of which 40% or so was ore that we were buying, or sorry, concentrate that we were buying off the market from third parties to help run the POX plant closer to capacity, you know, spread the fixed costs over more ounces. The margins on the third-party concentrate are much lower. So obviously it's more beneficial for us if we can load the POX with our own concentrate. And here you can see in the Q3 and Q4 of this year, that proportion of third-party concentrate goes down substantially. We will have about 12% in Q3 and 13% in Q4 of third-party concentrate. Most of what's going into the POX now, which is now operating at close to 100% capacity, is going to be our own concentrate. And much of that thanks to the opening of the Pioneer flotation plant in May. Here's just a quick point here. Just you can see the difference in margins between when we run our own concentrate through the POX plant and when we run third-party concentrate through the POX plant. The difference in margin is 50% versus 9%. So very important for us to increase our flotation capacity and to send more of our own concentrate through the POX plant. Here's a quick slide about how we're adding more flotation capacity to process that refractory ore. As I said, Pioneer opened on May 31st. And we're also expanding Malamir, which was our first flotation plant. It has 2 lines. We're adding a 3rd line, and that'll bring the total group combined processing capacity to 9 million tons of ore per year. And if you can see this little chart here on the bottom, you can see how over the next 3 years, Pioneer will increasingly be processing refractory ore to the point where in 2023, only 15–16% of what it will produce will be going through its legacy plant for non-refractory ore. And Malamir has already basically gone through that process. Malamir is more or less 100% processing refractory ore at this point. I talked about Albin a little bit earlier. It's our 3rd mine where the Albin open pit itself is depleted, and so now we're mining from the satellite field, Elginskaya. In the resource here, you can see that the gold is bigger than the gray. That means the non-refractory ore is bigger than the refractory ore. That's in the official JORC resources that we have for that deposit. But as we're mining, we're finding out that it's actually just about the opposite. It's about 2/3 refractory ore or transition ore, and only a 1/3 non-refractory. So the old Albin plant, it's still working. It's processing that non-refractory ore, but to get to it, we have to mine substantially more refractory ore and stockpile it. So what we're looking at now is creating a 3rd source of flotation concentrate for our POX, which will get us almost up to 100% capacity with just our own ore concentrate. And that would mean adding either converting half of the existing Albin plant to flotation so that it will process refractory ore, or building a separate plant at Elginskaya, or both, because we also have Unglichan here in this cluster, which has also substantial refractory resources. So pre-feasibility study on this is in progress, and we plan to present what we think we will do with this cluster during our Capital Markets Day later in the month. A quick look at the first half of the year. As you probably noticed from that chart earlier, as I mentioned, we had this downward trend of production. And so in the first half of this year, our production was down 26% year on year. A large chunk of that was because of third-party concentrate. Last year, we had kind of a one-off where we got a big delivery of third-party concentrate with 100 grams a ton grade, which is substantially higher than what we would normally process. Right now, we're averaging around 30 grams a ton. So that kind of spiked our production last year. And so obviously in the first half of this year, you see a big drop off. Our financials basically tracked down with the production almost one for one, but we did turn a net profit in the first half. Our own TCC was slightly higher, and I'll let Danila go into the reasons for that a little bit later on. Balance sheet and liquidity, we bought back $136 million of our outstanding $500 million note using some low interest loans. And again, I'll let Danila go more into the balance sheet and liquidity issues later on. On the development side, as I mentioned, we launched Pioneer Flotation. The Mann flotation expansion is currently on track. On health and safety, in the first half, we had zero injuries. We had a slight uptick in, zero fatal injuries. We had a slight uptick in LTIFR, but that was more due to a new health and safety team coming in and instituting some more stringent reporting standards. We're actually seeing a downward trend as the months go by. COVID-19, we had no material impact. And as of last week, we are now up to 71% of our employees fully vaccinated. And that's part of a program that we started in the first half to vaccinate people on site and to encourage people to get vaccinated. And we had no major environmental incidents. Our outlook for the second half is we expect an increasing contribution from Pioneer because of that launch of the refractory ore processing capability, the flotation plant, stable production from Malamir and Albin. Our cost of production guidance remain unchanged, and I'll talk about that at the end of the presentation. And as I mentioned, for the next few weeks, we'll have a capital markets day. Hope to announce the date for that very soon, and we will present our new corporate strategy at that point. Here you can just visually see how our production went down in the first half, and you can see a large chunk of it was from that third-party concentrate because of that difference in grade. Last year the average was around 60, this year it's around 31, and that's just a function of the third-party concentrate that was available on the market for us to buy, because we actually didn't really get into contracting all the concentrate that we needed until the new team came in place this year, and that meant a lot of the concentrate that might have been available on the market last autumn, which is when people normally do the contracting for the next year, wasn't available to us. Here you can also see Malamir, a slight dip just because they're basically transitioning fully over to processing refractory ore, and the second half should be very strong from them. Pioneer, the only real difference with Pioneer, again, is you're starting to see that refractory ore coming in the first half of this year, but also there was a small period where we had to shut down the plant in preparation for the launch of the new flotation plant. So second half, again, for Pioneer should be very strong. Albin, this difference is pretty much a permanent difference because of the difference in ore between Albin and Ilginskaya. But again, we reiterated our guidance for the year despite the drop in the first half. And the second half we expect to be much stronger. And this is the last slide for me before I hand it over to Danila to talk about the first half financials. Just a point I mentioned earlier about the business review that we've been doing. It's been pretty wide reaching. We used outside consultants to help us go through the structure and the contracts and everything. We have made the Moscow office much leaner, about a third leaner than it was when we came in, but also removed a lot of duplicated departments, made more clear lines of reporting, and administrative headcount therefore was reduced. We've also gone through all our purchasing and logistics, contracting. We reviewed over 100 counterparties to find out if there were some interested party transactions going on between, at various levels of the company. We actually ended up blacklisting about 30 contractors. We've eliminated purchasing via intermediaries and resellers and are dealing directly with suppliers and contractors now. And that's actually cut out quite a bit of fat. And on the back of that, of course, we were reviewing all our policies and procedures. We instituted a tender committee to make sure that all of our purchasing is transparent and proper. And we actually had to let a few employees go who we found were dealing with companies in which they were somehow interested. As a result, you can see we saved about $26 million in the first half. Now, some of this is Capex, some of this is OpEx that will filter into the P&L in the second half because a lot of this work was done in the spring. But we think we've made a good start, at least, in terms of making this company leaner and more efficient. And with that, I will pass over to Danila to give you a quick look through our first half financials.
Sure, John. Yes, yes, ladies and gentlemen, let me give you just a quick overview of our results of 6 months of this year. In order to put this information into the context, as John has mentioned already, the majority of our ratios here are in red, which basically reflecting yes, and trailing on the production and sales of the gold. Yes, reasons of that John already explained. I can just underline again is that yes, of course, we have the decline in profitability in the first half against the first half of last year, but yeah, the reason of this is the decline in production of our own gold, mainly because of the transition of both of the Pioneer and on the Albion, and it's a trend which is being reversed at the moment. Although I would like to give you a few explanations in order to explain the particular reasons of the difference in cost of the production and some deviations of some other ratios. John, can you switch to the next one, please? Here you can see the breakdown. It's a explanation of bridge between the EBITDA of H1 of last year and this year, as I mentioned already and John mentioned already. So the majority of the difference, yes, in red here, as you can see, is the result of the decline in the volumes of the gold we're producing. Second one is the increase in the cost, but I would like to note here that the level of the cost and the increase is in line with our expectations, and actually it's on the lower range of the guidance which we gave at the beginning of the year. So all this has been expected, and we can explain the reasons of this in the next slide. As you can see here, also quite a significant amount of this difference between last year and this year is the result of the volumes and the grades of the gold we're producing out of the concentrate we're buying in the market. And as John explained here, reason here is that at the beginning of last year the company enjoyed the one-off opportunity, which it used when it purchased a high-grade product which was available in the market 1.5 years ago or 2 years ago, and also used it was not yes, in one-off opportunity when we purchased it when the price of the gold been at lows, and we extracted the gold and sold this gold at the beginning of last year when the gold price has been on the uprising or trend already, and this was one of opportunity. We used it, but it's no longer available. What I can note here is that also this decline of the share of the EBITDA of our associate company RC is the reason of the accounting approach. Since the end of last year, the company has changed the accounting approach and now is accounting the RC as a disposable asset, because it's the view of the management. It's the strategy of the board of the management is to remove the guarantee of RC and dispose of the stake, and on the basis of this, we are not including the results of the RC in the ratio of EBITDA. Otherwise, this number will be high, of course, because of the high price in iron ore in H1. John, can you switch, please? Here is it's a bit of information to give you the idea why the amount of EBIT and the free cash flow out of the operating activities, what is driving the difference. And I think it's worth explaining this. As you can see here, the biggest impact in terms of the working capital changes is increase in the stockpiles of the ore. It's primarily the effect of the Albin. As we mentioned already in the beginning of this year, we transitioned from the depleted pit on Albin into Elginskaya, and apparently the composition of the ore in Elginskaya is a bit of different of what we've been expecting. With a significant amount of the refractory ore. That's why we, as a strategic development of the company, we are looking at the building flotation, at the flotation in Albin, and in order to extract the ore which we are able to process on the plant which is existing, we have to stockpile a significant amount of the ore, which we're going to utilize in a few years. But without doing this, we won't be able to reach the deposits of the oxide ore. Although we can mention here that the significant amount of this ore which we are required to extract and stockpile been accumulated already. And another item which we traditionally would like to note in order to make or to explain the difference is repayment of the gold advances, which is a quasi-debt on the balance sheet in the company. So in the previous year, the company was using the gold advances as a kind of the quasi or borrowing a source and a source of the liquidity. So at this moment of time, we're replacing these gold advances with a source of cheaper liquidity, and we are planning to close this to zero by the year end. In terms of other items, there was accumulation of the work in progress of the WIP of the GIC, the gold, with the commission of the Pioneer. Although this is also like one-off item, and we're not expecting this, any increase in the future. And in terms of the green items, of course, a part of so the positive side of some decrease in the production of the gold out of the concentrate we are buying is a decline in the working capital which is associated with it. And as also as we were mentioned in our announcement, using the positive trend in the price of iron, the IRC was able to generate a significant amount of the cash flow, and as we can see here, we received a significant amount of the guarantee fee, which was due at the beginning of the year. We quickly run to the next one. So here, in terms of the TCC, which we mentioned already, I think it's worth a quick explanation. So obviously, the transition in terms of switching to the process of the refractory ore at Pioneer and switching into the new mine Albin, it has a effect on the cost of the company. As I mentioned already, this increase in the cost is totally in line with the guidance, and actually it's on a lower range of the guidance, as you can see also here, partly the increase was expected on the basis that the subsidy on the taxes which the company enjoyed in the previous years expired, and we're paying full amount of tax. Although I can add here is that the new project Elginske, we have plans to use the preferential regime on taxation next year, when we're expecting high amount of the Capex, and this will allow us to get more of the benefits. Can we switch, John?
Mm-hmm.
A little bit of the comments here, as we explained already. I think the significant, the primary impact in terms of the increase on the TCC in terms of our own gold was the Albin. And Albin, we can only add again is that the transition has happened like in February. It means at the beginning of the year we still were working on the depleted volumes of the ore in Albin with the low grades, and yes, and also in the beginning of in the second half of Q1 we've been also in the process of increasing the capacity in terms of the processing of the Elginske ore, which properties are slightly or different of the ore of the Albin, and also are more difficult in terms of the processing, and has it's also an impact on the TCC. Although we're expecting that the trend will be changed yes in the future. So I'm mindful of time, so let's quickly look at other slides. I think here our Capex in the first half of this year is lower than it was last year. It's also lower against the guidance we provided, although this is timing or difference. We're planning to catch up with the program that we announced at the beginning of the year, with the emphasis on the building of, with the emphasis on the expansion of the Malomir, which expansion of flotation plant we are planning to commission mid of next year. Switch, yes. In terms of the change in the debt, I think it's worth it's worth noting the information which is here in the text. What I would like to note here, because of the decrease in the EBIT of the company, where we're looking at the increase of the leverage against the very low ratio of 1.5 at the end of last year, although it remains quite comfortable level. And I think it's very good news that we can add here is that again, using the strong environment on the price of an iron ore, IRC was able to significantly decrease the amount of its indebtedness with the Gazprom Bank, and hence it decreased. As a result of this, the amount that we're guaranteeing is much lower than it was at the beginning of the year, and actually the amount here at this moment of time is even lower. And this is it's a good it's a positive improvement in terms of the ratings of the company and the potential view of the banks on the situation of liquidity of the company. It decreases the risks, and it improves the terms of the money which we are lending. And on the next one, slide, we can quickly update you here the situation with the debt of the company. It remains one of the focus of the management, as you can see here at the end of last year. Yes, the middle of last year, the majority of that was in high yield notes. What we have changed over over the course of this year is that we attracted a significant volumes of the liquidity with the banks, with the rates which are quite attractive, and they are much more are much lower than the cost of that the company has in previous year, and we are using this as a primary source of the working capital, and opposite of using the gold advance, where the rates were much high. And in terms of the dealing with the maturity of the high yield notes, as John also mentioned, we made a tender offer mid of this year, we replaced the part of the debt with the bank loan GPB with extended maturity and at terms which are much more attractive. And as at this moment of time, the management is looking at the different ways of refinancing the remaining amount of the remaining amount of the notes, and we are planning to utilize the window of opportunity which we're seeing at the moment, and that's our plan to do it within the next few months. Although I think the exact plans are going to announce on the market, and we're agreeing on the strategy. John, I think it was the last one, or not?
Yep.
Maybe we'll move into Q&A, otherwise we'll run out of time.
Yeah, I'll just fast forward and show this real quick before we move to Q&A. Just to point out that our guidance for this year remains unchanged, 430 to 470,000 ounces. Of that, 370 to 390 will be from our own ore. Our cost guidance remains unchanged. As Danila mentioned, we've been towards the lower end of this guidance for the first half, and we expect that to continue in the second half. And we actually have come in already below our guidance on processing costs for third-party concentrate. So that's looking good as well. And Danila already mentioned that the first half Capex was below last year, but this is our budget for the year, $140 million, which we expect to spend by year end, even though we only spent 43.5 in the first half. And yeah, I guess we'll throw it up in the questions.
Many thanks, John, Danila. Thanks again for a very informative and interesting presentation. Now we move into Q&A session. Dear participants, you can ask your questions in two ways. You can either raise your hand or type it into Q&A panel. Both are located at the bottom of your Zoom app. While we pausing for a moment, allowing our audience to formulate their questions, I'll use the opportunity and fire the first one. You mentioned that it looks like Albin is pretty much depleting. Do you have any plans to do any exploration work there? Because it looks like, judging by the resource base and the grade and the quality of ore, you could benefit by expanding it.
Yeah, let me actually, let's go back to that slide. Let me clarify that a little bit, because that's not exactly what happened. So basically, the Albin mill is located here. If you see the slide where Albin is, and the open pit near there has already depleted as of around this time last year. So since then, basically starting in January, we've been mining the Elginskaya deposit, which is about 35 kilometers away. So the reason you've seen the drop in Albin production this year is not because of the depletion of Albin, but it's because we've been feeding the Albin mill with Elginskaya, which the ore is harder. Which means reduced throughput through the mills, and it's also lower grade and harder to process, so lower recovery. So that's why Albin has seen a drop off from last year to this year in terms of its production. But what we're saying is, going forward, what we're finding as we're mining is that Elginskaya has a large component of its reserves which are refractory. And so that's why we're saying we need to look at adding flotation capacity to the Albin plant or a separate flotation plant for Elginskaya to be able to process that refractory ore, which right now we're just stockpiling while we send the non-refractory ore to the Albin plant. As part of that whole process, as part of this pre-feasibility study for determining what kind of additional processing capacity we need in this cluster, we are actually conducting about 30 to 50,000 meters of drilling at Elginskaya this year to get a more clear definition of the deposit and do technological mapping. And that will inform the process about whether or not we add, or what kind of flotation capacity we add there. So yes, we are doing exploration there. Also Unglichan, which is another satellite deposit. We're doing exploration on both of those this year. But the focus is on Elginskaya, and that's about half of our exploration Capex this year is on Elginskaya.
Many thanks, John, for a very comprehensive answer. Dear participants, just to remind you, you can ask your question by either raising your hand or typing your question in the Q&A panel. Both features are located at the bottom of your Zoom app. The next question probably should be addressed to Danila. We are well into second half of the year, and what we've seen in other industries and particular in the mining sector is the escalation of three magic words: labor, fuel, and materials in terms of cost. Without getting into exact numbers, how do you see cost dynamics in the second half of this year, and do you expect it to spill over into 2022?
Yes, let me answer this. It's a good one. In terms of the cost inflation, if you look at the dynamics of our cost, which I mentioned already, and I can underline again, is that we are remain at the guidance. We believe that our cost will be within the guidance which we provided, with a slight increase. And in our case, a slight increase in the cost was inevitable. It's basically the company is more and more switching into processing only the process of only processing the refractory ore. And of course, the refractory ore, it requires additional cost of the processing on the box, and it's inevitable. Your TC's allowance will increase, and this is what is happening with the company. Although, as John mentioned already, the management is putting lots of efforts on control of the costs, and was able to, on the basis of the business analysis, which is still ongoing, to idea and address a number of the cost mitigation measurement, which gave its fruits already, and we're expecting that this effects on P&L will be visible in second half of this year, which John already mentioned, and we believe that we have an opportunity to improve the cost. In terms of the inflation of the cost of the fuel, of the labor, and of consumables, which I mentioned, yes, there is obviously, we cannot avoid that. In terms of the we all, as I mentioned already, because we have an associate company, IRC, which is engaged in mining, trade, and iron ore. We've seen a significant increase in the price of iron ore, and it's reflected in the prices of steel, of the coal, and it's of course, as while it's been beneficial in terms of the business of IRC, of course it has a direct impact in terms of the cost of the ball, or in cost of the balls which were put in the mills. and also further fill construction which we're using. And yes, this yes, it has impact on our cost, but this is not. I would not overvalue it. I think that the majority of the cost increase, which you've seen in our analysis, it goes with the properties of the ore, with the grades, and with the changing in terms of our ability to increase the capacity of the POX. And in our guidance, which John mentioned at the end, we noted that if at the beginning of the year our outlook on our cost of the ton of the concentrate we are processing on the POX, we estimated like between $180 to $100. We've been able with increasing increasing the capacity, we've been able to achieve the optimization of this, and right now we're looking at the number of 160, 180. And this is one of the examples. And what John is showing at this moment of time is the number of the optimization initiatives, which are mainly on the side of the improvement of the efficiency of the work of the procurement, which affected the cost of the fuel and consumables, a number of services which we are using in the company, and it has a direct positive impact. And I think this will be reflected in the costs. And in terms of the general inflation of the costs, yes, we are not insulated, and of course we will get a certain impact of that, but I would not overestimate.
Okay, understood. Many thanks, Danila. We have the first question that comes from our audience. Nikolai, I'll read the question. John, good day. You mentioned the dividend policy. When exactly are you going to come back to discussion of it? What are the present terms of it now? What parameters are the key for starting paying dividends? Thank you.
Yes. So, obviously, we believe the dividend policy has to be part of the broader strategy, because we need to know how much Capex we have going forward. We need to know how we're going to manage the debt, which Danila has been working on, including the $360 million in notes next year, and all that. So it's all going to be kind of a complex approach. Obviously, there's a commitment to it. The board is already discussing it. There's not yet been a determination on whether or not we're going to base it on EBITDA or free cash flow or net cash flow for operating activities. Obviously, it'll have to be based on some metric that we can provide the market with some comfort and some easily comprehensible guidance. But that's where we are now. When we do the Capital Markets Day with the rest of the strategy, it'll be an integral part of it, and then at that point we'll be able to say when the first dividends will start to flow.
Okay, many thanks. Mentioning your high yielding debt, do you have any plans to refinance or issue new debt, taking advantage of relatively low rates right now?
Yes, let me answer this. Yes, of course, we're actively looking at this, and as I mentioned already, as a step one, we did the partial buyback of the notes in July, August of this year, replaced it with the bilateral loan with the GPB at the interest rate, which is, let's put it this way, which is in line with the terms of RCF which we are getting, and which is at least half as low as the coupon we are paying at the moment. The company is actively looking at the window of opportunity of refinancing the remaining portion of the debt. Yes, we are closely looking. We're looking at opportunities on the market. We're watching and of course aware what our peers are doing. Okay, although we have to look at a number of the corporate events which we believe will be close at the end of this year. I mentioned what I mean here is the investigation of the KPMG. It is important that we close this matter and we approach the market without any questions open in relation with this, and we're expecting that this matter will be closed and concluded by the year end. And actually, at this moment of time, also I can note is that we believe that the market of the banking debt is also extremely attractive, and you can see here an example of the terms which we are getting with the banks, and the company and the management is looking at the different opportunities of how to approach the refinancing of the remaining portion of the debt, but it shall be closely aligned with the strategy of the company. And this is what management is actively working at the moment with the plan to kind of announce the strategy, yes, and put a certain outlook in the numbers and to discuss it with investors. I believe it's either like at the end of October, begin of November, but in any case within like a month or a month and a half. And on the basis of this, we're going to agree on a strategy, and management is open and looking at the different opportunities, including the mixture of the DCM instruments and also the loan with the banks. Basically, it's what we have at the moment. We have a mixture, and our key priority is obviously is to increase the maturity, and by using these opportunities. Using these opportunities in terms of the interest rates in the market, reaches significant the maximum improvement in terms of the interest rates. And as I was showing on a slide, I believe we are progressing quite well with this.
Many thanks, Danila. Next question comes from Sergey.
Hello, gents. Thank you for the presentation. That was very interesting. I have a very short question. Can you please disclose, if it's possible, what is your internal gold price for the budgeting purposes for 2022-2023? Thank you.
We are using, I can answer this. We are using we are analyzing the consensus outlook of the banks on the prices, and we're using kind of when we analyze this, we're not using the mid-range, we're using kind of the lower range of the outlook, and without giving the exact digits, I think the price we are looking at the next year is yes, is lower than the current level. I think that it's an average the price in next year, which analysts are providing, it will be around 16 or 50. I think around, if without giving the exact numbers, around all of this. We believe that this level of the price, this outlook on the price, it will allow us to avoid excessively negative outlook, although, and of course, avoid excessively positive outlook. We do not want to go into extremes in terms of our assessments in order in order not to cut the opportunities which we might be able to use otherwise in terms of the capital expenditures, new projects, etc. I hope that
Okay. Okay, thank you. And do you have any sort of, did you conduct any sort of stress test scenario with the gold price going significantly lower?
Yes, of course we are looking. Yes, of course we are in doing any analysis. We are looking at the different scenarios, including like including extremely negative. And I guess your question is what kind of mitigating actions like we've got. But I think the answer here will be, and it's again, it will be subject to the strategic review of the long-term plans of development of the company. Although, if for example, like your if you're looking at the curve forward curve of the price of the gold, or you're looking at the outlook of the analysts and they give you like the outlook of 1700 a little bit below this in the next like year or two, and your view is that there is a risk of significant drop in the prices, then the answer will be to do the hedging. And at this moment of time, as you're probably aware, we are not hedging any significant amount of the price of the gold, but it's one of the instruments which we are looking at, and it will be subject of the review of the management. But yes, in answering your question again, I would answer that if the strategy of the company, it assumes that I don't know, the prices it shall not be lower than the level of 1600 in the next couple of years, and at this moment of time, the instruments which are securing this level of the price are available. In that case, the answer on this analysis, which you mentioned, will be to go and hedge at least part of the production, and this is what we're looking at as well. Although at this moment of time, there is no clear view until we approve the strategy and discuss it with investors and the shareholders.
Thank you.
Many thanks. Many thanks. I think we ran out of questions. I see no further raised hands. Dear John, Danila, many thanks for a very informative presentation and a very informative Q&A session. That concludes our presentation. We'll be very happy to see you next year. We're wishing you best of luck. Hope we'll hear from you soon. We'll dial into your Capital Markets Day. And that concludes our presentation. Many thanks.
Thank you, Yuri. Thanks for having us.